Greencoat UK Wind is not that exciting of a name, and its business model isn't particularly exciting either. So why do I keep buying it? It's been nearly 3 years since I first made a video on UKW. It has since paid out 25p per share in dividends, which works out at around 20% of the 2021 share price. The share price has also grown about 15%, making it a good investment so far. Firstly, UKW is a renewable energy infrastructure trust, which basically means they own and operate wind farms. They do not manufacture anything themselves. As the name suggests, they're based solely in the UK. They pay a growing dividend which is linked to inflation. This is the main source of investor returns. They continue to invest using excess cash or debt to acquire new wind farms. They could soon push into the FTSE 100 as their market cap is nearing the bottom of that stock index, but they are currently sitting in the FTSE 250. As mentioned, the business is pretty simple, and this graph gives a good overview of the business model. Cash generated from wind farms by selling generated power, of which they currently have 46 wind farms. Cash is then used to pay dividends, and the remaining is reinvested to acquire new wind farms. The business model is also self-funding and does not rely on further equity issuance. New equity has been issued in the past, however this is less likely in the near future due to excess cash being generated and a share repurchase program that is currently ongoing. Their wind farms across the UK have a capacity of nearly 2 gigawatts, which I believe has now actually been exceeded with new acquisitions. This has grown from 1.1 gigawatts 3 years ago, showing very impressive growth just in 3 years. There used to be a self-imposed cap of 40% offshore wind. However, I believe this has been scrapped, most likely as there has essentially been an effective ban on new onshore wind being built in the UK, so it would have been hard to stick to this cap when trying to grow the portfolio. As mentioned at the beginning, the dividend is linked to inflation. The yearly dividend will increase based on December's retail price index reading. So December 2022's retail price index was 13.4%. So therefore 2023's dividend was increased to 8.76p from 7.76p. In Q3 2023, due to strong cash generated in 2023, the full year dividend was increased to 10p a share, making the yearly increase around 30%. Now 2020's forward dividend target is also 10p, so technically it looks flat when compared to 2023, but that includes the increase at the end of the previous year, so without that it's another 13% yearly increase. Now one of the most important metrics for a stock like this is its dividend cover. So one-time cover means that all the profit goes to paying the dividend, and a two-time cover means half the profit is used to pay it. So an average dividend cover of 2 times since IPO means 50% of their profits are being reinvested back into the business. And more importantly, the dividend is very sustainable and they have room to increase it in the future. As mentioned, dividend cover is not just important for the dividend being sustainable, but excess cash is then used to invest in new wind farms and buy back shares, therefore increasing investor returns. So it's important to have a large dividend cover. Around half of UKW's income is fixed by ROC and CFDs, which essentially decrease exposure to power prices, and the price per megawatt hour is fixed. But prices paid to UKW per unit of energy increases with inflation under ROC and CFD contracts. In April 2023, ROC rose 11.6% and CFDs rose 10.1%. This is a major component to reduce their risk and adding to their dividend sustainability. With a lot of their profits being fixed to inflation, and when their dividend policy is also fixed to inflation, there isn't a huge lot of room for things to go wrong, as we can see in the dividend cover table. But first, looking at the predicted power price curve, which is done externally by experts. They take a power price estimate and then apply a 20% discount to this to be even more conservative. These figures feed into the table where it shows, based on forecast, that the 2-time cover will continue. But more importantly for me, if something unexpected was to happen and power prices plummeted, the dividend is safe at £20 per megawatt hour, and even safe for the next 4 years at a massive low of £10. 2023 looks to be another great year for UKW. Full year results have not been released yet, but we should have a very strong growth in capacity and also net asset value. Predicted in Q2 results, they should generate over £200 million excess cash above their annual dividend. This will be used to pay down debt, make new acquisitions, and additionally they announced a share repurchase program worth up to £100 million. The £100 million share repurchase program has come at a great time, with the stock trading at a fairly large discount when compared to the net asset value. Current discount of 11% means that for every £100 of shares you purchase, you gain £111 of assets. With the exception of the past year and a half, UKW the majority of the time trades at a premium. So the company is very effectively using their cash as shares are undervalued currently. They are essentially gaining 11% on shares repurchased. And of course, the main advantage of this program is to reduce the total shares outstanding and thus increasing the value of NAV per share and therefore the share price. Additionally, less shares outstanding reduces the cost of dividend payments as there are less shares to pay dividends to. The number of shares in issue has already decreased by nearly 9 million from June 2023, which would represent a roughly 0.7p increase in the net asset value per share. Going forward, it would be nice to see the share repurchase program remain, given that shares are still at a discount. So why are shares trading at a discount? Lower risk and lower return assets decrease in value as the discount rate or the risk-free rate of return increases. Now this is applicable to all assets, but as the returns for UKW are unlikely to be as high as other equities over the long term, investors are less willing to take the risks associated with UKW over the risk-free rate, leading to falling share price despite the fundamentals of the company remaining unchanged. With their 10-year UK bond yield around 4%, and UKW targets investor returns of 10%, this excess above the risk-free rate is of course lower than it was when interest rates were near zero. On the right, we can see how the changes in certain factors reduce or increase the net asset value. Although a great inflation hedge, high inflation often results in increasing interest rates, which mostly cancel out the gain from the higher inflation. The other risk I wanted to briefly touch on is the asset life. Turbines have a limited asset life. Currently, the average age has risen to 7 years, with 23% over 10 years old. However, the assumed lifespan of assets is 30 years, so it currently isn't a concern, and if the portfolio keeps growing, the average age will remain low. Probably the largest investor concern, and likely the reason for shares trading at a discount, is the amount of debt. The total gross asset value before debt is considered is actually £5.8 billion, or 252p per share. However, this is reduced to the net asset value we see. Due to £2 billion in debt, this debt represents a 34% of the gross asset value, with their investment policy capping this at 40%. Of course, with rising interest rates, a large debt pile is bound to be a concern. Even if sustainable, the higher interest payments will affect cash flow. This debt is spread across a wide range of interest rates, some as high as 7.4% or as low as 2.2%. £935 million of this debt is at less than 3%, with £610 million being fixed at a very low 2.6% for the Hornsea 1 project. This has led to a weighted average cost of debt of 4.08%, which would still result in large interest payments. It's not too high, and with a cap of 40% debt, I feel that they can keep this under control. It would become more of an issue if rates were to go higher and inflation was very low. But as this is very unlikely to happen for an extended period of time, I think the debt level is okay. Now looking at their earning growth, it's been fairly strong and predictable due to average wind speed being consistent. Also shown on the right, UK wind speeds don't vary massively, with only a 10% standard deviation in wind energy over a single year, dropping to a very low 2% over 25 years. Also, UKW utilises fixed price contracts like ROCs and CFDs, which increase predictability, less of concern if power prices have a large temporary drop. Net asset value has consistently been growing faster than inflation, which will most likely be reflected in the share price. But additionally, you have a dividend on top of the net asset value growth. You could give yourself an additional 6.7% a year if you bought today, as that is the current forward yield. And as explored, the dividend is very safe. The stock has performed fairly strongly over the past 5 years, returning 43%, beating the market, which is the FTSE 250's return of 24%. What's impressive about this beating of the market is that the stock has done this while being substantially less volatile. With a beta of 0.3%, it is theoretically 70% less volatile. Additionally, UKW has mostly outperformed other renewable energy infrastructure trusts. There are three main reasons why I say Greencoat UK Wind is a good buy. It's because firstly, the current forward dividend yield is very high, sitting at 6.7%, which will increase yearly with inflation. Second is the stock is trading at a large historical discount, well below the long-term average, and the premium has been over 20% in the past. Lastly, as mentioned, I don't foresee UKW generating exceptional returns. However, I do see it to continue to beat the FTSE 250, and doing this while maintaining low volatility, especially during a market downturn, as it is not very correlated with the general market. Thanks for watching. I'm hoping to get more stock analysis videos out in the next few months, in addition to stock market basic videos, similar to my best performing video, which looks at the two types of ETFs accumulating and distributing. So do subscribe so you don't miss these.